Hello and welcome back to Digital Assets Daily. Good morning, good afternoon, or good evening, wherever you are in your corner of the world. Right into some articles, Ripple price analysis into the abyss, but there is one historical level nearby. Ripple is over 20% lower on Thursday on a bad day for the crypto community. The price has a historical low close to where the price is now. As this author states, looking at the daily chart below, you can see marked by the big red arrow, a support level from 16th of July 2017 when the market was pretty volatile and the massive price crashed, managed to find some support at the 12.9 cent mark. Will it happen again? Only time will tell. And below this chart, he added a current price action in the chart. So you can see that the price support is not too far off the 138.2% and 161.8% fib extension level, which could help if that level is broken. This would take the pair and uncharted territory, and Bitfinex data also has an important level at 13.5, which could come into play. So on the screen we have his charts. I guess this is 2017, and here we have the current chart, and they reasonably similar. And you have here on the screen, if you're able to view, he has additional levels. Previous day, daily low, daily high, monthly high, weekly low, the Fibonacci percentages, etc. So the big thing is now we're, what did it hit today? Like 15.9 or something. Yeah, so 3 cents off 12.9 exactly. So we're about 3 cents away from the low before the last major bull run. I guess I clicked on these by accident. So the next article, as we get into, Ripple XRP is just 3 cents away from reversing the mega gains of 2017, and will Brad intervene? It's a little similar to the last one, but I think he's kind of pointing the finger towards Brad on this one, giving him the responsibility of pulling it up. But at the same time, we know there's some manipulation going on, but Ripple obviously does not control the price. Let's see. There was something else I wanted to get into on this one. Oh, here we go. Even in the depth of bears, Brad Garlinghouse is confident of Ripple and XRP, while there are accusations of Ripple dumping on holders as they fund projects and expand XRP user case through spring, and CEO recently divulged that the company plans for an IPO in the next year. Also in an interview with CNN, he said it wasn't in their best interest to see XRP prices crumble. Ripple is the largest holder of XRP and has embarked on a decentralization strategy, even pausing programmatic sell-off of the coin via exchanges to steady prices. The reaction from the community has been mixed, but some are optimistic that this is net positive and in the long-term draw demand for XRP. So again, as the author states on this, but at the same time, I would have to agree with Brad. It doesn't make any sense for them to crash and keep dumping XRP. I mean, it is one of the stable coins such as XLM. But again, don't confuse that with the fixed one-for-one such as USDT and USDC. Stable coin, the reputation has been given by the central banks and from the Bank of Canada, and such as the Payments Canada, are stable coins titled for XRP and XLM, meaning it is less volatile than the other coins, making it a stable coin. Many people in the community continue to misunderstand the meaning of that coin, but as a new investor, that's what you need to understand. Also, too, as I was requested, as in a discussion earlier, we were discussing the bear market and the bull market, and new investors asked if I could clarify that, as they are new to investing, but they understand the potential for cryptocurrency and digital asset investing versus traditional stocks. So here we go. We're going to go into this a little bit for the new people. If you understand the bear and bull market, feel free to turn off your video right now, because now it's basically going to be set for the new investor to understand. As we get into the bear market is a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Typically, bear markets are associated with declines in an overall market, an index like the S&P 500, but individual securities or commodities can be considered to be in the bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. So you can see why the 20% margin is frequent within the investing community, as people say, oh no, it's a decline of 20%, it's an official bear market. Or if you hear, yes, we had 20% ascension, like there's a climb of 20%, then you know you're in a bull market. I don't want to get ahead of you or ahead of myself here, but we'll keep moving forward. The key takeaways of this is the bear markets are markets in which the prices of securities fall by more than 20% amid widespread negative investor sentiment and fear. And when you have the negative sentiment and fear, you typically have like the FUD, the fear, uncertainty, and doubt. Although the only difference is a lot of the FUD can be created intentionally and is intentionally spread at many times. The bear markets can be cyclical or secular. The former last for several weeks or a couple of months, and the latter can be last for several decades. Short selling put options and inverse ETFs are some of the ways in which investors can make money during a bear market. And a lot of people make money going up and down. It doesn't even matter. But there you have it. Just remember, 20% negative is basically your bear market. 20% positive is going to be your bull. We'll get into that shortly. The U.S. major market indexes were close to bear market territory in December 24, 2018, falling just shy of a 20% drawdown. More recently, major indexes, including the S&P 500 and Dow Jones Industrial Average, fell sharply into bear market territory between March 11 and 12 of 2020. Prior to that, the last prolonged bear market in the U.S. occurred between 2007 and 2009 during the financial crises, and lasted for roughly 17 months. The S&P 500 lost 50% of its value during that time. And also, too, December 24, 2018 was a year after XRP's last major bull run in 2017, which overflowed into mid-January of 2018. Also 2007 and 2009 during the financial crises is kind of what gave the birth to cryptocurrencies. There was something to protect yourself from all of the, at the time, volatile and crashing of the fiat currencies globally. And so the digital assets and cryptocurrencies such as Bitcoin was born. And here we are today. The secular and cyclical bear markets can last for multiple years or just several weeks. A secular bear market can last anywhere from 10 to 20 years and is characterized by below average returns on a sustained basis. There may be rallies within secular bear markets where stocks or indexes rally for a period, but the gains are not sustained and prices revert to lower levels. A cyclical bear market can last anywhere from a few weeks to several years. The naming of bear and bull, the term bear market is the opposite of a bull market or market where prices for securities are rising or are expected to rise. The bear market phenomenon gets its name from the way in which a bear attacks its prey, swiping its paws downward. This is why markets with falling stock prices are called bear markets. Just like the bear market, the bull market is named after the way in which the bull attacks by thrusting its horns up into the air. What causes a bear market? The causes of a bear market often vary, but in general, a weak or slowing or sluggish economy will bring with it a bear market. The signs of a weak or slowing economy are typically low employment, low disposable income, weak productivity, and a drop in business profits. In addition, any intervention by the government and the economy may also trigger a bear market. For example, changes in the tax rate or in the federal funds rate can lead to a bear market. Similarly, a drop in investor confidence may also signal the onset of a bear market. When investors believe something is about to happen, they will take action, and in this case, selling off shares to avoid losses. In the phases of a bear market, you have the first, they typically have 4 phases. And in the first, you have the phases characterized by high prices and high investor sentiment. Towards the end of this phase, investors begin to drop out of the markets and take in profits. In the second phase, stock prices began to fall sharply, trading activity and corporate profits began to drop, and economic indicators that may have once been positive start to become below average. Some investors begin to panic as sentiment soars or starts to fall, and this is referred to as capitulation. The third phase shows that speculators start to enter the market, consequently raising some prices and trading volume. And in the fourth and last final phase, the stock prices continue to drop, but slowly. As low prices and good news starts to attract investors again, the bear market starts to lead into a bull market. And as a contrarian investor, the best time to invest is in the bear market. The bear market versus correction. A bear market should not be confused with a correction, which is a short-time trend that has a duration of fewer than 2 months. While corrections offer a good time for value investors to find an entry point into stock markets, the bear markets rarely provide suitable points of entry. And this varies because it is almost impossible to determine a bear market's bottom. Trying to recoup losses could be an uphill battle unless investors are short sellers or use other strategies to make gains in falling markets. And what they're saying here is a bear market is where it's really tanking down. And let's give an example of the crypto and digital asset investing. They always say, if you cannot handle a 95% drop, then you cannot handle the 30,000% gain. So between the 1900 and 2018, there were 33 bear markets, averaging one every 3.5 years, and one of the most recent bear markets coincided with the global financial crisis occurring between October 2007 and March 2009. During that time, the Dow Jones Industrial Average, the DJIA, declined 54%. And to go back into the statement, the difference between the bear market full bottom, where we say in the crypto and digital asset investing, the 95% drop. But the correction is where you have a new high, and then it corrects, it drops down a little percentage, but the new low is still higher than the old high. It tends to go sideways there at many times, and then begins climbing again. And again, new highs and new lows are always higher than the old high and lows. And that's the difference between a bear market and a correction. Short selling in bear markets, the investors can make gains in a bear market by short selling. This technique involves selling borrowed shares and buying them back at lower prices. It is an extremely risky trade and can cause heavy losses if it does not work out. A short seller must borrow the shares from a broker before a short sell order is placed, and the short seller's profit and loss amount is the difference between the price where the shares are sold and where the price where they bought back, referred to as covered. For example, an investor shorts 100 shares of a stock at $94. Price falls and the shares are covered at $84. The investor pockets a profit of 10 times 100, which is $1,000. If the stock trades higher unexpectedly, the investor is forced to buy back the shares at a premium, causing heavy losses. I personally stay away from any kind of trading, though those experienced traders can make a lot of money. I'm a long-time investor. In it for the long term, that's it. Puts and inverse ETFs in bear markets. A put option gives the owner the freedom but not the responsibility to sell a stock at a specific price on or before a certain date. Put options can be used to speculate on falling stock prices and hedge against falling prices to protect long-only portfolios. Investors must have option privileges in their accounts to make such trades. The inverse ETFs are designed to change values in the opposite direction of the index they track. For example, the inverse ETF for the S&P 500 would increase by 1% if the S&P 500 index decreased by 1%. There are many leveraged inverse ETFs that magnify the returns of the index they track by 2 and 3 times. Like options, inverse ETFs can be used to speculate or protect the portfolio. There is a video here. Feel free if you want to come back and click on that, because I do include the links to every article we discuss in the description below. The real-world examples of bear markets: the ballooning housing mortgage default crisis caught up with the stock market in October of 2007. Back then, the S&P 500 had touched a high of 1565 on the 0.15 on October 9. By March 5th, 2009, it had crashed to 682.55 as the extent and ramifications of housing mortgage defaults of the overall economy became clear. Most recently, the Dow Jones Industrial Average went into a bear market on March 11, 2020, and the S&P 500 entered a bear market on March 12, 2020, and this followed the longest bull market on record for the index, which started in March 2009. Stocks were driven down by the effects of the crisis and falling oil prices due to the split between Saudi Arabia and Russia. And yeah, I kind of stumbled there on that one for a moment, because as content providers, we cannot discuss that word and say it out loud, or we tend to get demonetized or have our videos deleted. So pretty much you're not going to hear anyone discuss this. They will call it something else. Other examples are the 1929 Great Depression and the aftermath of the bursting of the dot-com bubble in March 2000, which wiped out approximately 49% of the S&P 500's value and lasted until October 2002 is another example. All right, then we're going to go into the definition of a bull market. What is a bull market? A bull market is the condition of a financial market in which prices are rising or are expected to rise. The term bull market is often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. Because prices of securities rise and fall essentially continuously during trading, the term bull market is typically reserved for extended periods in which the large portion of security prices are rising, and bull markets tend to last for months or even years. And again, here there is another video. Feel free to come back and click that link as well and watch the video. Understanding bull markets. Bull markets are characterized by optimism, the investor confidence and expectations that strong results should continue for an extended period of time. It is difficult to predict consistently when the trends in the market might change. Part of the difficulty is the psychological effects and speculation that may sometimes play a large role in the markets. For example, the large bull run that we had in 2017, when Bitcoin saw a high price of $20,000 per Bitcoin, was a speculation bull run. That's why this time it will be much different. This bull run is much more exciting for those investors who have been here, 2 years, 5 years plus, because we got to see a few of the last previous bull runs and the significant gains that they had. So therefore, there is no speech until universal metric used to identify a bull market. Nonetheless, perhaps the most common definition of a bull market is a situation in which stock prices rise by 20%, usually after a drop of 20% and before a second 20% decline. So as you have the bear market as a drop of 20%, the bull market is typically judged by its rise by 20%. Negative bear and a positive bull, but both typically determined by the 20% rise or decline. Since bull markets are difficult to predict, analysts can typically only recognize this phenomenon after it has happened. A notable bull market in recent history was the period between 2003 and 2007, and during this time the S&P 500 increased by a significant margin after a previous decline. As the 2008 financial crisis took effect, major declines occurred again after the bull market run. Bull markets generally take place when the economy is strengthening or when it is already strong. They tend to happen in line with strong gross domestic product, the GDP. And a drop in unemployment will often coincide with a rise in corporate profits. Investor confidence will also tend to climb throughout a bull market. The overall demand for stocks will be positive along with the overall tone of the market. In addition, there will be a general increase in the amount of IPO activity during bull markets. Another thing that we're anxious to see this year, Ripple is planning their IPO is expected to launch before end of year 2020. So that will be an anxious thing. They were listed as a $10 billion company for their price. IPO was projected to be set at $61 per share. But a few weeks ago, I saw the purchase, which I believe is due to expire next month, if I'm not mistaken. You can buy in at their IPO. It was a minimum of I know overall they had 800 shares, and I believe the price was $20,000, but they did have a second option, a bid option at 400 shares for $10,000. Basically, you're getting the stock at $25 a share, knowing that it's currently worth $61. So if you do have that $10,000 or $20,000 ability to dump in something, you may want to consider the IPO that Ripple is releasing. You can check with a few different companies. I forget off the top of my head the company that I went through and saw their options. I did not get the IPO, any of the stock options. I basically remain an investor in the currency only, just to have full clarity. Notably, some of the factors above are more easily quantifiable than others. While corporate profits and unemployment are quantifiable, it can be more difficult to gauge the general tone of the market commentary. For instance, supply and demand for securities will seesaw. Supply will be weak while demand will be strong. Investors will be eager to buy securities while few will be willing to sell. In a bull market, investors are more willing to take part in the stock market in order to gain profits. And here again, we have another video. If you are interested, again, same story. Click the link below in the description, as it will be included. Bull versus the bear markets you have here. I'm not going to go into this paragraph here because I want to do a summary on that. So we'll go back to the bull market specific. How to take advantage of a bull market. Investors who want to benefit from a bull market should buy early in order to take advantage of rising prices and sell them when they've reached their peak. Although it is hard to determine when the bottom and peak will take place, most losses will be minimal and are usually temporary. Below, we'll explore several prominent strategies investors utilize during bull market periods. However, because it is difficult to assess the state of the market as it exists currently, these strategies involve at least some degree of risk as well. And again, that is something I do not do. I'm a price average long-term investor, and that is it. So be very careful if you guys do any of the trading and the different strategies like that. It's too much risk for me. I'm not even interested. I know where this is headed. I know where it's been. I know where it's going. I saw what it did in speculation. I know where it's going in utility. Buy and hold. One of the most basic strategies investing is the process of buying a particular security and holding on to it, potentially to sell it at a later date. This strategy necessarily involves confidence on the part of the investor. Why hold on to a security unless you expect its price to rise? For this reason, the optimism that comes along with bull markets helps to fuel the buy and hold approach. And there you go. Buy and hold. I definitely like that one. Increase buy and hold is a variation on the straightforward buy and hold strategy, and it involves additional risk. The premise behind the increased buy and hold approach is that an investor will continue to add to his or her holdings in a particular security so long as it continues to increase in price. One common method for increasing holdings suggests that an investor will buy an additional fixed quantity of shares for every increase in stock price of preset amount. Now, my strategy is different from this, as I do buy and hold, but the only time I increase my buy and hold, the opposite of this, is as it dips, not as it climbs. Retracement additions. A retracement is a brief period in which the general trend in a security's price is reversed. Even during a bull market, it's unlikely that the stock prices will only ascend. Rather, there are likely to be shorter periods of time in which a small dip occurs as well. Even as the general trend continues upward, some investors watch for retracements within a bull market and move to buy during these periods. The thinking behind this strategy is that, presuming that the bull market continues, the price of the security in question will quickly move back up retroactively, providing the investor with a discounted purchase price. Exactly as I was stating right here is my strategy. I do the buy and hold, and then I do retracement additions. So for the full swing trading, perhaps the most aggressive way of attempting to capitalize on a bull market is a process known as full swing trading. Investors utilizing this strategy will take very active roles using short selling and other techniques to attempt to squeeze out maximum gains as shifts occur within the context of a larger bull market. A bull market is a period of time in financial markets when the price of an asset or security rises continuously. The commonly accepted definition of a bull market is when the stock price rises by 20% after two declines of 20% each. Traders employ a variety of strategies such as increased buy and hold and retracement to profit off bull markets. The bull market example, the most prolific bull market in modern American history, started at the end of the stagflation era in 1982 and concluded during the dot-com bust in 2000. During the secular bull market, a term that denotes a bull market lasting many years, the Dow Jones Industrial Average, DJIA, averaged 16.8% annual returns. The NASDAQ, a tech-heavy exchange, increased its value fivefold between 1995 and 2000, rising from 1,000 to over 5,000. A protracted bear market followed the 1982 to 2000 bull market from 2000 to 2009. The market struggled to establish footing and delivered average annual returns of negative 6.2%. However, 2009 saw the start of a 10-year bull market run. Analysts believe that the last bull market started on March 9, 2009, and was mainly led by an upswing in technology stocks. And to add to this here, from 1982 to 2000, as they state, the dot-com bust. Chris Larson, I shared a video, a recent one of him this year, where he states we are still early in knowing how this climbed all the way to 2000. He said we are about in the 1995 area, equivalent to the dot-com boom. So the NASDAQ, a tech-heavy exchange, increased its value fivefold between 1995 and 2000. So you can see that 5-year period is how Chris Larson states we currently are in the crypto and digital asset timeline. I want to do another overview of the bull and bear market. And I really appreciate the Investopedia because it's going to explain this much better than I could have just given it to you. And it's easier than me to just read from this and add to it. The terms are simple, but their cause are incredibly complex. Almost every day in the investing world, you will hear the terms bull and bear used to describe market conditions because the direction of the market is a major force affecting your portfolio. It's important that you know exactly what the terms signify and how each one affects you. And again, that's why I took the time when requested to make this clarity, because you're going to hear constantly every day of your investing bull and bear market. Because in the crypto and digital asset sphere, it is a 4-year cycle. Again, you have back 2009, 2013, 2017. The next major bull run peak is 2021, basically a year away in Q4. But the next exciting thing is, after that, the stated maturity of the entire crypto market is the following major bull run peak in 2025. So that's my plan from day one. For years I've been holding in the expectation of reaching that crypto maturity market. So again, I think that last paragraph is very important for new investors. Understand and know the bull and bear market. What are bear and bull markets? The terms bull and bear market are used to describe how stock markets are doing in general. That is, whether they are appreciating or depreciating in value at the same time, because the market is determined by investors' attitudes. These terms also denote how investors feel about the market and the ensuing trends. Simply put, a bull market refers to a market that is on the rise. It is typified by a sustained increase in market share prices. In such times, investors often have faith that the uptrend will continue over the long term, and typically in this scenario, the country's economy is strong and the employment levels are high. By contrast, a bear market is one that is in decline. Share prices are continuously dropping, but resulting in a downtrend that investors will believe is going to continue, which in turn perpetuates the downward spiral. During a bear market, the economy will typically slow down and unemployment will rise as companies begin laying off workers. The key takeaways that you're going to want to know: a bull market is a market that is on the rise and is economically sound, while a bear market is a market that is receding, where most stocks are declining in value. Although some investors are bearish, the majority of investors are bullish. The stock market as a whole has always posted returns. A bear market is more dangerous to invest in, as many equities lose value. Since it is hard to time a market bottom, most investors withdraw their money from the markets and sit on cash until the trend reverses. And if you do enough research and you understand that your asset has a use case, a good team, and good partners, you're probably going to be very excited to invest in a bear market. The characteristics of bull and bear markets. Although a bull or bear market condition is marked by the direction of stock prices, there are some accompanying characteristics that investors should be aware of. The following list describes some of these factors. You have supply and demand for securities. In a bull market, we see strong demand and weak supply for securities. In other words, many investors are wishing to buy securities while few are willing to sell. As a result, share prices will rise as investors compete to obtain available equity in a bear market. The opposite is true, as more people are looking to buy than to sell than buy, and the demand is significantly lower than supply, and as a result, share prices drop. Investor psychology, because the market's behavior is impacted and determined by how individuals perceive that behavior, investor psychology and sentiment affect whether the market will rise or fall. Stock market performance and investor psychology are mutually dependent. In a bull market, investors willingly participate in the hope of obtaining a profit. And that's what many of us are here for, making a profit. During a bear market, market sentiment is negative, as investors are beginning to move their money out of equities and into fixed income securities as they wait for a positive move in the stock market, and the decline in stock market prices shakes investor confidence, which causes investors to keep their money out of the market, which in turn causes a general price decline as outflow increases. The change in economic activity, because the business whose stocks are trading on the exchanges are participants in the greater economy. The stock market on the exchanges are participants in the greater economy. The stock market and the economy are strongly linked. A bear market is associated with a weak economy, as most businesses are unable to record huge profits because consumers are not spending nearly enough. This decline in profits, of course, directly affects the way the market values stocks. In a bull market, the reverse occurs as people have more money to spend and are willing to spend it, which in turn drives and strengthens the economy. And again, here we have another video. Feel free to click on the link and watch that if you are interested. Gauging market changes, the key determinant of whether the market is bull or bear is not just the market's knee-jerk reaction to a particular event, but how it's performing over the long term. Small movements only represent a short-term trend or a market correction. It's a longer time period that will determine whether you see a bull or a bear market. And this is very important. Perfectly timing the market is almost impossible. I would agree, that is very important. Not all long movements in the market, however, can be characterized as bull or bear. Sometimes a market may go through a period of stagnation as it tries to find direction. In this case, a series of upward and downward movements would actually cancel out gains and losses, resulting in a flat market trend. And what to do in each market. In a bull market, the ideal thing for an investor to do is take advantage of rising prices by buying stocks early in the trend if possible, and then selling them when they have reached their peak. During the bull market, any losses should be minor and temporary. An investor can typically actively and confidently invest in more equity with a higher probability of making a return. In a bear market, however, the chance of losses is greater because prices are continually losing value, and at the end is not often in sight. Even if you do decide to invest with the hope of an upturn, you are likely to take loss before any turnaround occurs. Thus, most of the profitability will be found in short selling or safer investments such as fixed income securities. An investor may also turn to defensive stocks whose performances are only minimally affected by changing trends in the market and are therefore stable in both economic gloom and boom cycles. There are industries such as utilities, which are often owned by the government and are necessities that people buy regardless of the economic condition. And the bottom line is both bear and bull markets have a large influence on your investments, so it's a good idea to take some time to determine what the market is doing when making an investment decision. Remember that over the long term, the stock market has always posted a positive return. And I'll add to that, it is true. You can't help it as a new investor. You're going to watch your investment, and you're going to see in a bear market, your value of your investment is going to drop right before your eyes. And at the same time, in the bull market, you're going to get completely excited to watch it rise at the same time. So again, I hope this helped answer a lot of the questions in regards to the bear and the bull market, because that's something that you're going to hear like forever, or for as long as you are an investor. And that's pretty much it. I think the Investopedia did an excellent job on that description, so there was no sense in trying to do anything better. Just wanted to share that with you, so now you are completely aware. I'm going to finish off this video with a final thought. The only way to guarantee failure is to never try. Again, guys, this is not financial advice. It is for entertainment purposes only. And we'll catch you in the next one.